What's the biggest shift you've noticed? It's been 3 years since you've last done this survey. What's the biggest shift you've noticed as we're headed for these higher yields?
Right. So a couple things. One, thanks for having me. As many of our viewers may know, we own 60% of a life insurance and retirement company called Global Atlantic. So we believe in this market. We interviewed 50 CIOs globally that oversee about 20% of the overall insurance market. So massive amount, $7 trillion. What you saw from 2017 through today was a real move into real estate credit, private equity, private credit, and structured products. Generally, people were moving, they were selling investment grade debt, trying to get higher yield, particularly after the pandemic. So that's kind of where we've been. I think what the piece really highlights through the survey and through our conversations with our CIO partners is where they're headed. And the number one thing, Alex, that came out is infrastructure. And it really plays off of some of the clips you just said, which is people want asset-based collateral with cash flows that has some pricing power. So infrastructure is becoming a much bigger part of the overall asset allocation, albeit from a small base. We're still seeing growth in real estate credit. We're still seeing growth in private equity. But what's interesting from the CIO's perspective is they're not necessarily taking more risk per se. They're actually moving up the quality curve, both in the liquid markets and the illiquid markets. They're just finding non-traditional investments that can provide return in an environment where you have to say the central banks are creating a real issue for savers by putting rates down to zero. And that's really the conundrum and what we've been working with our partners to try to work through together.
Henry, these funds are super tankers. They move incredibly slowly. You've got to go through a number of different layers to get decisions made in terms of making these shifts. What are they saying to you about the timeline on which they're operating at the moment? How quickly can they make these pivots?
Yeah, guys, it's actually an excellent point because we're talking about a tanker ship, right? The average CIO that we interviewed oversees more than $100 billion in assets. And think about what happened from 2017 or 18 through 2021. They increased their non-traditional investments by 12%. That's a massive shift, right? And it came at the expense of liquid equities as well as investment grade debt. What the intentions that we learned through the survey is that trend is going to actually accelerate. And so I would think, using the right risk management tools, the right portfolio construction, you're going to see that continue to increase because even though rates are up a bit from lows, they're still down extraordinarily. They're still way low relative to where we were. Just look at the survey results where you see that the average yield has dropped 100 basis points from 4.2% to 3.2%. And that's a massive amount when you're trying to create yield for retirees.
100%. Which leads me to the question of what are they most worried about? Here we talk about political risk and inflation. Really, it's inflation and the Fed. What are they worried about?
It's fascinating. Actually, we had this real bifurcation between, it was some form of inflation. A lot of the CIOs are worried about deflation, and some of them are worried about inflation. I would say if you had to generalize, life insurance companies are probably more concerned about deflation because they've actually extended the duration of their liabilities, and they want to match their assets with the liabilities. So lower rates would be quite problematic. On the property casualty side, similar to what you were mentioning earlier, we are seeing input costs going up, and the property casualty insurance companies are worrying about having replacement costs going up, and they're worried about reflation or inflation. So it's a pretty bifurcated market, but I think what they agree on is that we've had outsized stimulus, and there's going to be some reaction in the capital markets over the next couple of years, either some concern about a deflationary bust or some concern that we've overstimulated, and that's going to lead towards reflation. As a firm, KKR, our balance sheet, we're the largest investor in what we do. We're tilting more towards the reflation camp, for what it's worth.
What about the stagflation argument? How does that sit with you, Henry?
I think one of the anomalies this cycle is going to be that real rates stay low and we actually have decent nominal GDP growth. Guy, when you look at what's going on with productivity, people aren't talking about it. Productivity is booming. It's booming. And so the idea that we don't have any GDP growth, particularly at a time when consumers have this much excess savings, I don't see that. So I think we're all entering a new period where, think about what the Fed said last week. They have a forecast for 4 years where inflation is above their trend. Above their trend of 2%. We went through a decade, the last cycle, and you guys did a great job reporting on this, but we went through a cycle where the Fed only saw inflation go above its mandate two times in 10 years. And now we've got them saying that it's going to happen for 4 years consecutively. So we're all going to learn together on how to do this, but our tilt has been more collateral-based cash flows, more upfront yield, and focus on areas where both complexity and illiquidity accrues to your favor. And I think you see that doing that in partnership with our clients.
Hey, Henry, something that's also changed in 2018 is the shift into this green energy transition. It's been pretty furious, but there's been a lot of questions as to the kind of money you can quickly allocate to, sort of overpaying for assets or investments. And I'm wondering how these tanker ships, as you guys are calling them, invest in that theme.
Well, it's interesting. What came out in the survey is they're playing that both through the equity as well as through the credit. So I think a lot of times people just talk about the equity, but infrastructure credits become a big business for our clients. I think you were touching on this earlier. There's this delicate balance, and what you're seeing is the shift towards renewables is a very powerful one, and we're hugely supportive of that. But some of the infrastructure is not in place to really deploy the capital in a thoughtful way. And so we've really had to focus on areas where we have areas of expertise and there's actually the infrastructure in place. At the same time, you can't leave the old economy behind. And so you're reporting on the UK where natural gas prices are high. In the US, oil prices are high. This is a global phenomenon where there's going to be this tension between what we think is a $70 trillion investment opportunity over the next couple of decades, offset by this pressure that it can't happen maybe as fast as some of the politicians are mandating on their decarbonization acts. And so that's where we have to work together, private sector, public sector. Yep. We have a huge infrastructure business, and we're navigating that alongside our clients, but it's tricky.
Henry, one final quick question from me. When you look at the investments in your portfolio right now, how strong is the correlation between those assets? How much of them ultimately, when it all boils down, is the same trade?
That's not the case. I think there's some very good data in the exhibits, particularly when you look at real estate versus infrastructure versus private equity relative to insurance assets. So that's important. If you had to say what's the one thing you watch, Henry, it's credit. Right? This cycle, when we do a lot of internal models in terms of what drives growth over time, we think we're going to have plenty of in demand because of a lot of the injections into the system, higher savings. But the Achilles heel would be that financial conditions tighten. That's not our call, but what we are watching is credit and the rate of money supply. So I'm sure we'll be back talking about it, but that's the area to focus on.